Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, so today I have Adam Chopin on the line. He's Director of Multi-Asset Sourcing over at Exponents, and today's episode is part of our iConnections New York series, where we bring you the best of those that are attending or have attended iConnections heading over to New York. Adam, welcome to the show.
Thanks for having me.
All right, so we got a lot to talk about today. So, of course, I want to get into Exponents and, of course, and then the overall angle, the edge for boutique asset managers within a scale industry. So I think that's a highly interesting topic. So have some fun with that one. But before we get into that, iConnections New York, I know you're going next week. Have you been in the past? Is this your first conference? Give us some of the background, please.
Yeah, I've been to the iConnections New York 3 or 4 times now. Went to the first one right after the pandemic, which was actually the first conference I went to after the pandemic. It was a good crew. And I've done the one down in Miami a few times, as have some of my colleagues. And they've become the class of cap intro conferences. If you hate cap intro, if you hate speed dating, don't do it. But like us, when you're trying to find new managers to allocate to, this is a good official way to do it. It's a great venue. They do a good job.
That's awesome. Lots of different ways in conferences and things that obviously you can spend your time. What keeps you coming back to this one specifically? I'm curious.
Scale and efficiency. They're big enough that for us, we look for managers in a very particular set of niches. It's a numbers game, right? The smaller the thing you're looking for, the bigger the pool of opportunities you need to have. And so this makes it very efficient. New York certainly is the firm that's based in Philadelphia. New York's sort of in our backyard. Take the train up, no big deal. So the conference is very convenient. And they frankly just do a good job organizing. And they keep getting better with their database and their online stuff, which is good. They're the class of these events.
That's awesome. So switching to the topic here slightly, talk to me about Exponents. Tell us a little bit more about the firm.
Yes, we've been around for about 30 years. We manage about $25 billion for U.S. institutions, and we've got 4 main lines of business. In-house, we manage systematic equities, which is a lot of it. The vast majority of that is passives or a lot of custom passive stuff for U.S. institutions. And then we have a fixed income platform that is about $3.5 billion. That is Barclays Ag or Bloomberg Ag or whatever the benchmark is called these days. Core fixed income approach, also for all institutions. And then we have the multi-manager business, which is our sort of flagship business going back to the mid-90s and where I've spent most of the past 13 years on that side. And that's where we allocate externally to boutique or emerging managers, depending on whatever parlance you want to use. Yeah. And then we also have an alts arm that does something similar. It's a little bit unique in that it's a GP and LP ride-along investing, but it's focused on investing alongside or into the GPs for private asset managers. And we have that as a joint venture with a larger firm that we have had just about 4 years. So that's the newest part of our business.
Let's go further down that thought process of the boutique asset side of things. Why might there be an edge there? I thought this was an interesting topic.
Yeah, so scale is the enemy of some types of investing, right? It's not necessarily true, but in everything, but as a numbers game, right? At some point, if you manage a mutual fund, the fund itself is so large that the only thing you can get liquidity in is whatever the largest stock on the index or largest stock in the most liquid stock in the universe. And so, which changes every day of this week. Maybe a couple months ago I said it was Nvidia, maybe it's Samsung or SKI. Yeah. But scale is the enemy, and that's true for most asset classes, right? And so that's not where most of the assets flow for all sorts of inefficiencies in the way we do business. So it creates this sort of interesting tension and opportunity for those who can exploit it.
That's interesting. So I guess it's kind of a broad statement, but why don't they get more assets? Or why aren't more people? Because I've done a lot of interviews. I've been covering this for a long time. I don't hear many people pick this angle. I'm just curious.
Yeah, so lots of allocators, including many of the largest and highest profile pensions and sovereign wealth funds, are constrained to invest in larger managers because of either rules they have internally that set limits on the percentage of AUM they can be, or just the rigorous hoops of their RFPs and super long allocation timelines that, in effect, give them an eligible universe of just larger managers. And then that cake gets baked, and then those large allocators effectively set the hurdle for consultants and sort of smaller institutional investors who are then sort of de facto incentivized not to stick their neck out too far from the crowd. And so the crowding into the larger managers thickens further, right? And then you layer on top of that something which I think has come and maybe going, but is true today, that for traditional asset classes, the industry sort of moved away from paying performance fees. And in fact, U.S. mutual fund regulations make it extremely hard to charge them in a retail fund at all. And so that led to a focus by fund managers on operating as businesses focused on scale instead of alpha. And so you have both of these various factors coming together to incentivize multiple actors across the industry to perform at scale or to try and to manage scaled businesses as opposed to managing businesses for alpha. But then, of course, the inverse is also true, right? That if you can unshackle yourself from some of those constraints, there's a ton of alpha available to find if you just roll up your sleeves and do the work.
Interesting. Switching topic here slightly, let's get into maybe DEI investing a bit. So is it dead? Is it hiding? And like, what's your take on this?
I love this question because for all the sound and fury around anti-DEI stuff over the past year and a half, and there was obviously an awful lot of sound and fury there for a while.
Oh, yeah.
We've barely seen any change in interest. And net, we still see it as meaningfully more in favor than prior to 2020. So now, just as context, us as a firm, we are Black female-owned business, the largest in our industry, and one of the 2 or 3 largest Black-owned businesses in asset management. And then we've had as a part of our preference for working with diverse and women-owned managers in our external allocations, both on the public and private side. And that's been in our DNA since our founding about 30 years ago. For some of your listeners who aren't in the weeds on this like we are, it probably bears explaining what at least I interpret or how we interpret sort of investing with a DI lens to mean. Because it probably also means different things to different people, even other allocators like myself in our industry. So for us, it essentially means that if you have 2 fund managers that are really equally as suitable, high conviction for an allocation, you give the nod to the one for whom the allocation would do more to help our industry, which looks overwhelmingly like me, a white man, to look more like the actual population of our diverse and equally gendered country, right? So now there's a lot of research out there that diverse or female-led managers outperform non-diverse managers, which is sound research. But the interesting question is why is that true, right? Because the data is sound. Now, I've been doing this for about 13 years, and what I've learned is probably obvious to many, but came as a bit of a surprise to me, and I explain it as selection bias. Most independent asset management firms of any color, gender, or based anywhere in the world were started by star portfolio managers who left large shops after a period of great success. That's just sort of a general truth about the industry.
Yeah.
But getting to be a star PM at a large shop from the position of an underrepresented group or being a woman is harder. And so by default, so sort of the sexism and the racism bake itself in those larger shops, in that bureaucratic climb to the top, right? And so only the very best rise to the top, creating a biased selection pool from those PMs who then made it to the top, right? And then and then all PMs sort of equally leave those to go on to found firms, right? The bias of who is more likely to be an entrepreneur, I don't think it has any color or gender lens, but it's from how you get to be at the top of those large shops that the bias happens, which I think I have found interesting. But again, I think for people
that's super interesting. When you explain it like that, it's logical. I'm not saying I know the data. I'm not saying, you know what I mean? Like I haven't dug into this like you're saying, but it's not like you haven't said anything where I'm like,
nothing
no,
crazy,
that,
right?
where I'm like, no, that doesn't make sense. Like I'm not even like, it's just logical what you're saying.
Companies and people behave, right? And group think sets in, and all these things, so.
Oh man. Well, final question here, Adam. So, I'll timestamp this right now. So it's June 4th, 2026. So for when we're recording this, what kind of conversations are you having around the office right now? Like, what's on the agenda as we head into, going into iConnections next week?
Oh, so many things. I mean, you're always trying, in our allocation time frame is like a year in advance, right? Like if we're making decisions today, it takes a while for them to really matriculate into our clients' institutional portfolios, which are slow moving and whatever. So we're always trying to think like, what is the market going to be rewarding or penalizing sort of a year forward? And we have a few things that we're more highly convicted on than we have been in years. And, I think that'll still be a sticker. Hopefully we're still right in a year. But one is within international markets, which is where the biggest chunk of our sort of externally managed assets are placed. We have a big preference for small cap over large cap. We just think that small cap international markets have been really beaten up over the past, 10 years, 5 years, 5 years really. And the dispersion is, or the range has gotten too wide and is going to close. And there's all sorts of catalysts we think for it. It's not just valuation, but there's things that are happening in the way the assets are flowing and who's doing what that we think there's a lot of reasons for it that I won't get into here. But that's one. And then two is a diversification away from the dollar in lots of places, or at least the buying of less U.S. dollars by foreign investors, which foreign investors need to buy about $1 trillion of U.S. financial assets, U.S. dollar denominated financial assets, sort of to balance the books, or otherwise the dollar decreases. And we just think that the foreigners are going to buy less. Not that they're going to be selling more, but just going to be buying less, right? So, and what that means is that, the dollar will depreciate, but this, this is talked about very widely. We think there's some second order effects into equity markets and risk markets that are underappreciated, in particular sort of favoring risk assets and more tangible book and some things like that we're trying to, which have multiple ways to be expressed in a portfolio. But the fundamental driver of that is that dollar move, which we think has a long way to go.
Adam, how do people follow up if they want to learn more about Exponents? How do they connect?
We're on the web, and I myself am the only Adam Chopin on the planet, so I'm reasonably easy to find. You can Google me, send me stuff on LinkedIn. I will say to people who ping me on LinkedIn, I don't know who someone's name is that pings me but send me a note. If you send me a note, I almost always, accept it and respond. But we're on the web and we're out there, and we keep our door open.
Fantastic. And for everybody listening, just so you know, we'll definitely put some links in the show notes so that you can click on the link, head right on over, connect with Adam and his team. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. You heard me correct. Each and every day, we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So hit that subscribe or follow. And Adam, thanks again for coming on.
Thank you, Adam. It's a pleasure.